Well, first of all, before I start with my presentation, I'd just like to thank STOXX for having us and Cronet for inviting us. As ETF brokers, you hang out on these events every day, so it's very nice to see something new, see different opinions on things, because usually you get always the same thing. You're hearing about smart beta, and especially for us where we hang out here very often, it's nice to see different things. So, challenges of ETF trading and the significance of transaction cost analysis during the ETF selection process is what we are focusing on at Crossflow. We are a specialized ETF broker and an independent ETF advisor. And by that, as the smart beta area is very easily accessible in the last couple of years via ETFs and the broad range of ETFs that came up in the last years, you see that here on the right chart. I most probably think you don't see it, but you have to believe me that we have this is on the German market, by the way. So in the beginning of 2013, we only had a couple of ETFs, and that we see today on Xetra more than 100 listed there. And assets under management jumped, especially in the beginning of January 2015. And as we heard from Dr. Sauer yesterday, this is nothing new. Smart beta is nothing new. And as we had dividend strategies before, which we would count into smart beta area today. But as Dr. Sauer yesterday also said, he was surprised that this was like something new. But I would say it's not new, but in this environment we've seen in the financial markets, you need some opportunities. And the smart beta area is giving these opportunities, and obviously this is also pushed by the ETF issuers, and we can see really a broad range. What I'd like to point your attention a little bit today is the pitfalls we have when we are selecting ETFs and we are trading ETFs. And so how do we, if we have two ETFs on the same index, how do we basically compare them? What quality parameters should we take into account? And what we do is usually we separate the ETF, as the name already says, into two areas. We have the exchange-traded part of the ETF and the fund part of the ETF. And if we look at the quality parameters on the fund management side of the ETF, we definitely would look into the performance versus the total return index, so the performance difference to the index, right? So if the ETF manager is doing well, then the performance difference will be very small, and we would also look at the risk profile, in this case with the ETF, the replication method. Are they using a sampling? Are they using swaps? Are they having a fully replication and track the performance of the index? What I'd like to focus a little bit more today is the transaction management part. And we have the spread, the liquidity, as it was mentioned, the pricing continuity, and the settlement quality of an ETF that is nowadays really important when you talk to your compliance managers, when they say, hey, why do we have open positions? We traded it. What's the risk we're having there? And so on. So these are different points we should also take into consideration when we invest into an ETF and into the smart beta area. So let's say we are going to invest in the smart beta index, and we have two different ETFs. We've run the due diligence. We see that two ETFs could be interesting. We will, when you give an order to your trading test or through your order routings, then more or less the same costs will appear on your way to basically to put your trade into your portfolio. So we have commissions, we have stamp taxes, probably we have exchange fees that will be very similar with the same ETFs. And you have the time your order needs from your desk to the market to be executed. And all these things are basically implicit costs that are usually much higher than just the commission or stamp taxes or exchange fees. And what we also have to take into consideration is that we create a market impact with our order. Not with the small ones, but with the bigger ones, and especially in the smart beta area where we have smaller equity companies represented there as well. But if we assume that, again, we have two different ETFs based on the same smart beta index, also this market impact costs will be the same. But what makes the difference, that makes really the difference, is the spread costs. Because if we look at the market and even look into ETFs representing the same index, we will come up with different spreads. And if I just picked 3 random ETFs here, tracking the European equity market, 1 market cap weighted ETF and 2 minimum volatility ETFs, you can see that the spreads here already are very different, with in the first case almost 9 basis points, then almost 16 and 20 basis points. So obviously you could argue and say, well, of course a market cap weighted index has a smaller spread than minimum volatility ETF, but you can also see that there is a difference between 2 minimum volatility ETFs as well. So if we look at the spread, if they're different in the spread, so how is which are the components of a spread in an ETF? So first of all, obviously we have the underlying spread that is represented by the ETF as well. But we also have to take into consideration that we have a risk spread that the market maker will basically price into this spread. We have creation fees that probably need to be taken into consideration, stamp duties, hedging costs, holding costs probably that will be forwarded to the client as well. And last but not least, we have the P&L of the market maker, because these guys like to earn some money as well. So the components that we've seen here, that I would say is more or less the classic components we see in the ETF market. But if we also look a little bit further and look at the additional determinants of the spreads, we can see an interesting development. That is, here on the left-hand side, you have the spreads of the ETFs, and here the number of designated sponsors. Well, you probably know every designated sponsor is a market maker, but not every market maker is a designated sponsor, just to distinguish that a little bit at that part. And designated sponsor really has the obligation to be there and price the ETF. There are usually some agreements with the ETF issuers, so these guys are really there if you need them also in volatile markets. But as you can see, the more designated sponsors you have who are pricing the ETF, the lower the spread will get. And another very interesting point is that the more assets under management an ETF has, the lower the spread will get as well. And if we get another step forward and look at the average daily turnover an ETF has, and we've put here roughly 550 ETFs on the Xetra market, you also see that the spreads will get much tighter the more average daily turnover we have. So I've put it together here. So the spreads decline with rising assets under management, rising trading volumes, and with rising number of designated sponsors. So this is definitely something which should be taken into consideration when getting into the smart beta area with an ETF. We have here the basically the equity ETFs we have in our database, and 550 roughly, and we've taken out the dividend strategies and the smart beta strategies, not including the dividend strategies. And so our assumption of the tightening of the spread is shown here once again, that with a median asset under management of here 125 million compared to the dividend strategies of 156, and the average designated sponsors almost the same, we have a much higher median spread on the equity ETFs in general than we have on the dividend strategies here. And if we link to our assumptions we made here, go down with the number of assets under management and also with the average daily turnover with the smart beta ETFs, you see that the median spread jumps over 30 basis points. So I'm not saying that is right or wrong. It's just something you should be aware of when you're entering the smart beta area with ETFs. So in the graphs I've showed you before, I just colored the smart beta ETFs so that it's much more visible, and you can see that they really are not in the part here down here where we have up to, let's say, 10, 15 basis points of spreads. They are much more in the area of 20 to 40 basis points, and some of them much higher. Also in the, so we have here again all the 550 equity ETFs listed, and I've colored the smart beta ETFs here again, and you see again they are not in the lower part of the graph. They're a little bit higher here, between most of them between 20 and 40 basis points, and not in the area below 15 basis points. Same is true for the average daily turnover, and again, the cloud is much more in the upper area between 20 and 40 basis points than here the area where the average daily turnover is much lower. I mean, this is not really a significant point if you would expect that that ETFs are trading much more on the OTC market than on the exchanges, but this clearly gives an indication where we are heading to. So what's important for me today is that you just take away a couple of things. That is, that you really need to take the trading costs of an ETF, represented by the spread especially, into consideration. Yeah? Don't just look at an ETF and say, oh, look, the total expense ratio here is much lower, I'm going to buy this one. We've seen yesterday that it's already very difficult to choose the right factor, to choose the right recipe, as you showed, and get into that market. So unfortunately, there's another step we have to go, and we have to be very precise in the selection of the ETF we would like to use. So we also could say at this point that the spreads I showed, they're a little bit higher, and you would argue that obviously in the smart beta ETFs, they are often higher as smaller companies are taken into the indices. And I would agree with you, but I would also add that the smart beta area is not a trading area as other parts of the market. So just make sure that if you're using these instruments, that you also take into account that you're using them for much longer time, and you're not using them for liquidity management or things like that, that you just have to be aware that different costs appear here, but you get rewarded by additional performance for your portfolio. Thank you.